Hey everyone, Sloan Artel here. I am the founder of Invest Vegan, which is an ethics first registered investment advisory firm. And a lot of the clients that come to us are relatively new to investing. So I thought it might be helpful to kind of give folks an overview of like what the stock market is, and how we should use it to go on and live our best lives. But before we do that, I just kind of want to offer a quick disclaimer. Um, you know, the the contents of this presentation are meant really for your education. I'm not here to solicit business. I don't necessarily care if you become a client of mine or if this just kind of helps you locate the stock market in your future plans so that you can kind of proceed with a degree of added rationality. So this is all for informational purposes only. Nothing is legal, investment, accounting, tax advice, or whatnot. And yeah. So with that said, what we're going to talk about today are what stocks and bonds are, like what they, not physically because they're rarely physical things, but what they actually are, how a portfolio of stocks typically behaves. And then on top of that, since the way that I build portfolios here at Invest Vegan is quite different from the way that most people invest, after I've explained how a typical portfolio of stocks behaves, I'm going to sort of go into how to think about the way that what I do, which is more sustainability oriented, is likely to differ from those more traditional portfolios over time. So, you know, let's look at an example of a company so that we can understand like what stocks are in some more detail. And if you're trying to understand stocks, I don't think there's anywhere better that you can start than Crocs, right? Which, I mean, what fun. It's a company that rhymes with stocks. What's not to love? This Crocs happens to be in my portfolio, and it's one that a lot of people know, so I like to use it as an example. At one point, Crocs, the company, was sort of sitting around and realized that they needed more money so that they can make more stuff, right? And this is the traditional situation that most companies find themselves in when it becomes time to issue stock or go public, right? Usually they're fundraising for some broader purpose. In Crocs' case, it's probably, you know, making more Crocs. But there's this large group of people. You look at Mr. Moneybags over there on the left, or I guess genderless Moneybags, human. Although, I guess typically we would assume that a person sitting on a bunch of cash is a man, but whatever. Anyway, there is this large group of people who sort of sit around, manage money, and look at companies like Crocs as potential users of that money that they can charge, in order to kind of access that cash. And there are a variety of ways that happens. So let's look at the structure of Crocs itself. Every company has this thing called a balance sheet, which records the value of all of the assets and all of the liabilities that they have. The assets are things you own, right? It could be ideas. That's what the light bulb is there for. Factories. I think that's a particularly green one. That might be me being optimistic, but a factory is a pretty typical asset, and so is inventory, which is what's represented by that pile of boxes. Um, on the other side of the balance sheet, for every asset you have, you'll typically have a liability of some kind, and that liability will either be a borrowing, a loan, or it'll be ownership in the company. So that there's this kind of choice of how to fund your assets, right? You can do it by issuing stock, you can do it by borrowing money. Um, so that's like on the Croc side, that's how they'll think about it. On the investor side, your personal experience, the choice between owning a stock or a bond is, a stock is a share of the company, right? You are in the boat alongside everybody else and you will participate in whatever happens, right? Whereas a bond is a loan, right? You're lending money to the company, and the eventual payoff that you get is a function of a contract, right? So your best case scenario is that you get paid back everything that you're owed on time. And so as a result of that, kind of your upside is limited, but also your downside is limited. And like let's look at the actual history of Crocs, and then we can kind of talk about which one how the experiences of these two different types of investors might vary over time. So here is, Crocs's total revenue, that's total sales, amount of Crocs sold, right? And then there's the amount of profit that they made out of that on the bottom. So uh, you can see over time. I mean, recently this has been an excellent company to own. I've been very happy to own it. But for a while there wasn't really much growth there. Um, if you were a stockholder, again, you're participating directly and proportionally in all success or failure. I think Crocs has something like 61 million shares outstanding now. So if you owned one share, you'd own like 1/61 millionth of the company. Um, the bond, on the other hand, you get paid regularly and, really before the stockholders get anything, as a practical matter. I mean, that's a reference to bankruptcy where, like, if everything goes really badly, the company has to liquidate, the bondholders get paid before the stockholders get paid. Um, but like, there's sort of a spectrum of experiences here where, for the period of time that the company wasn't growing much in terms of sales, the lender to the company would be sort of the smart uh, person or the smart supplier of capital, right? Where there wasn't much of a growth experience to participate in, and so as a result, getting paid what you're owed on time is a much better experience than kind of participating one for one in a flatlining loss making company. But then at a certain point, a switch flipped and the company started growing again. And people who owned the stock started looking like geniuses or bandits or whatever. Whereas lenders, again, were limited to, kind of just what they had lent and then gotten paid back. And, this is a hypothetical example. I don't think that Crocs actually had bonds at this time. But the purpose here is to allow you to think about, okay, so, you know, there's this company, we're providing capital to it. There are a variety of ways that we could provide capital to it. And our experience as investors is going to be different based on the way that we provide capital to the company. So, anyway, in summary, what we've learned so far about what a stock and a bond is that companies issue them usually to fund projects, to do stuff. And bonds are loans, whereas stocks are ownership. And both of them are ways to charge people for using your money, right? Both of them are ways to kind of oversee the arrangement where I have some money that I don't really need. You have some projects that you can't really fund. We're going to work together, right? Um, yeah. So I hope that makes sense. And now that we've kind of looked at one stock, let's look at stocks in general. And I like to believe that all of these people are actually wearing Crocs in this stock photo, but I sort of know better. Anyway, yeah, there's even though it would be an excellent and very fashion forward choice, most professional investors or people playing professional investors in stock photo shoots don't wear Crocs on the trading floor. Anyway, so okay, so we have one stock. We know that we can, charge a company for using our money by either investing in stock or investing in bonds. But let's think about a big portfolio of stocks. What can we expect from it over the long term? Well, at some level, the good news is that the long term return experience of investors in diversified stock portfolios is relatively predictable. This chart goes from 1950 back to 2022, I think, and shows basically the returns that we could expect from a diversified portfolio of stocks. The S&P 500 is kind of the most widely used index of stocks over that long-term period. And that it's a pretty flat line. This line might look a little more flat than you're used to because it's on what's called a logarithmic scale, which is something that is used so that we can see the relationship between individual points on the chart more clearly instead of just sort of seeing something that goes from bottom left to top right, in a very dramatic fashion. But so the long-term experience of holding stocks is that you're usually pretty glad that you did it, right? You're usually pretty glad that you bought stock in 1950 come 2022. But what about the periods in between then, right? I remember the Great Recession. I've heard about the 70s. Aren't there periods where, stocks don't return that much at all? And in fact, where you lose money? Abso-freaking-lutely. There are a number of periods where, whether it's like if you invested at the top of the internet bubble or you invested, right before World War II or something like that, where you could have a decade or more of basically no returns. So the real trick with the stock market is being able to like live through that without selling your stock so that you can continue to experience the long term trajectory, right? And this is a chart from JP Morgan that shows the worst, kind of decline for stocks in any given year versus the end of the year return, right? So the red dot is the worst decline at any given point, and the gray bar is the return in that year. So what you see is that in every single year, there's a pretty significant drawdown in stock prices, right? Every single year, stocks go down every year. They don't usually, that's not usually all they do. They usually go up too, and more often than not, they go up more than they go down. But at any given point, there's going to be a period where stocks have gone down. So again, whether we're thinking about a year or a decade, when we're investing in stocks, we need to be prepared for that to happen. Right? So we can't be investing money into the stock market that we want to withdraw like next week. Well, the best way to do it and kind of retain your sanity is to be thinking, okay, well, this is for 10 plus years from now. So that not only are you not watching the market every second of every day and freaking out about whether or not the line is going to go up or down, but so that you can experience, kind of the excellent long-term returns that patient investors have historically experienced. Here's a great chart of that. This shows real returns on stocks, bonds, gold, and bills, which are a kind of shorter term version of bonds, sort of a short term loan versus a long term loan. And this is after inflation, right? So, what you see from this is that just holding the dollar, you can expect to lose about 1.5% of the value of your money over time. Gold, you can expect to kind of retain the value, but not grow significantly. Have a little bit under a 1% return. Bonds and bills, you can expect to kind of return, 3.5 to 2.5, 2.5 to 3.5% over time. But stocks have this after inflation, this history of providing, upwards of 6.5% annualized returns, even after inflation, right? So that is like really, really, really cool. And it's why, in so many cases, the standard advice on how to like arrange your financial life is that once you've paid all your debts or, kind of taken care of your short-term needs, that you start kind of socking money away into the stock market because, if you put it there now, 30 years from now, the odds are excellent that it's going to be greater. And this next chart sort of looks at that in a little bit more detail. What this is the highest and lowest returns on stocks, bonds, and bills over 1 through 30-year time horizons, right? So what you see at the left is that, kind of the best 1-year return from 1802 to 2012 from holding stocks is 66.6%. Which I'm just going to take as a nice wink from whoever. That's kind of a funny number. And the worst return that you had in that 1-year period is, roughly 39%. Right? But as you increase the amount of time that you hold the thing, you decrease the range of outcomes. That's a crucial point, right? So if you look out to the right hand side of this thing, the kind of best 30-year annualized return for holding stocks is 10.6%, and the worst is 2.6%. Again, those are annualized and after inflation. So in the worst case, from 1802 to 2012, if you held stocks for 30 years, you would get a 2.6% annualized return every year for that entire period after whatever inflation was. Okay. So I think that's pretty significant. And it's, partially why we put so much emphasis on the stock market. And, I think, and this is another way of saying the same thing from the same book, but basically, over a 1-year period, this looks at the annual returns versus the inflation that the world was experiencing in the year where the person made the investment. And what you can see is that, if you hold for 1 year, in a period of high inflation, average real return is basically flat for stocks. But if you held for 30 years, even despite periods of high inflation, the average real return was roughly constant at that same level from the chart before. Whereas bonds and bills, the kind of lower risk things where your payments are contractually guaranteed, um, inflation really, really eats into returns quite significantly. And so, in a higher return or in higher inflation period, like we're in now, there's even greater than usual reason to invest in stocks, right? That because they're more resilient in the face of inflation than quote unquote safer things like bonds and T-bills. Now, what have we learned from that? The big picture is long-term stock returns have been fairly consistent. Over 30 years, average returns around 6.5% after inflation. Short-term stock returns, though, very volatile, right? All sorts of things could happen. Anything, anywhere from up 66% to down 39%, right? That's a huge range of outcomes. That's 100% in absolute value. So uh, investing, trying to put money in the stock market to get something out of it a year from now is kind of a silly move. But the longer you hold stocks, the better, right? Now, at Invest Vegan, we are a queer firm basically no matter how you look at it. I'm a queer trans woman, so like, or queer in that way, but we also invest quite differently than most people do, right? Our mandate is to invest in companies that avoid preventable harm to living things while also shaping the future for the better, right? And one of the most common questions that happens in the academic literature and also in conversations with clients is like, okay, so how does investing in this way change our expectations for how our investments will perform, right? Does using this sort of ethical criteria change the expected return of our portfolio, right? And there's not really a definite answer on this so far, but I can tell you that there are certainly things like that that may happen that could reduce or change the way that we experience that our clients experience stuff relative to the average client. The first is that, like, if we look at the best performing stocks, this is from that same thing where we had a lot of those long term return things. Um, you find, first of all, a shocking number that were involved in the tobacco business, right? Philip Morris, tons and tons of these companies wind up getting, sucked into that thing. Other companies like Flint Coat, which may not be as recognizable, are, primarily notable for producing asbestos. All, of these 20 top performing companies from 1957 to 2012, I think maybe I could buy Dr. Pepper, maybe. And maybe I could buy Columbia Pictures, maybe. But none of these are companies that really look like the companies in our portfolio, right? And it's unclear if that's going to make our performance worse, better, whatever. In general, the people who gravitate towards my way of investing are people who, just wouldn't invest in those companies no matter what, and are looking for a way to experience as much of the benefits of stock ownership as they possibly can without transgressing against their moral convictions, right? So one way that our experience is likely to be different is that there's a lot of stuff that broad indexes will buy that we just don't, and that will make our returns different, guaranteed. Could they be different in a good way? Sure. Could they also be different in a bad way? Probably more likely on a statistical basis, right? In general, most people who pick stocks perform worse than the index, right? About 94% of funds over a 15-year period underperform the S&P 500, which is what all of those previous kind of graphs were based on. So we're going to be less diversified than the S&P 500, and we're going to own and we're going to be unable to buy a lot of the things that are in the S&P 500. And on top of that, as cool as I am and as great as my hair looks right now, I'm just kidding. I know it looks terrible. Uh, um, the I am not perfect and I'm likely to make mistakes. I'm likely to overreact to something or underreact to something. And that could be pretty material. And so, not only is there this level of like, you know, we have fewer options, but the options that we have to be decided on through this imperfect vehicle that sits on top of my neck. So that's another way that our experience may be different, is likely to be different than these other indices. Um, the third thing that I just kind of want to highlight is that markets change dramatically over long term periods, right? So on the left, we have the relative sizes of the world's stock markets in 1899. And on the right, we have the relative sizes of the world's stock markets in 2023. And what you see is that, America goes from being 15% of the global stock market to like 59%, 58% of the global stock market, sort of does this Pac Man thing. And the rest of the world kind of shrinks dramatically in comparison. Is it likely that the American stock market is going to stay at 60% of the world's entire stock market? I don't know. Not smart enough to tell you. And I don't really make predictions in that way. Um, but just there is a level of baseline uncertainty about any kind of future looking projection because past performance is no guarantee of future results, right? Whether you're looking at a giant set of things or a relatively small and more focused set of things like the Invest Vegan portfolio. So, there are uncertainties, right? But, even though Invest Vegan strategies may and are, in fact likely to perform differently than the market, um, the world has changed a lot, will change again. Even with all of that stuff being true, holding for the long term is still the best approach, right? Nothing that I said in this, how we're different makes it a good idea to try and, like time the market or invest for a short term period, right? I am still, benefiting from a lot of the same compounding forces that allowed, investors in the broad stock market to grow their money for so long. And I still try to discipline each and every one of my clients to, kind of regard the money that they entrust to me as long-term money that is there to grow and, kind of be talked about how it fits into their lives, but in general, not really moved around much. Um, you know, anyway, the big takeaway here is that if you have the capital to invest, and I don't want to take that for granted at all, it is unlikely that you will regret putting money in the market and leaving it there, right? Whether you do it with me, with an index fund, with some other advisor, it's usually not a bad idea if it's truly money that you can leave invested. And that's what I want to leave you with is that if you can identify money that is not needed for a debt or for charity or something else that you want to accomplish day to day, the stock market is an excellent place to put it. And if you share the same sort of values and ethical inclinations that I do, where you think that owning a tobacco company is not a way that you want to fund your retirement, we might be a good place for it. But regardless of that, I hope that this video helps you to understand this relatively abstract and strange thing called the stock market. And I would love it if you could, if you, ping me with any questions. My, email is sloan@investvegan.org. And you can, of course, go right to investvegan.org and send me an email, ask all sorts of questions. I love them and I will totally answer them. Thanks so much for your time. Mwah.